Okay, I would have loved to have done this in class, but I think that this medium of this recording and a video presentation is just as well, and maybe arguably slightly better, because you can pause and digest the information coming at you. What we're going to talk about is Section 482, which is the reason why I didn't remember the section last night, because it's not in the 900 series of code sections that we usually are accustomed to using for international taxation topics, but it's Section 482, as you can see, and the reason for that is it's been around a long time. That's number one, and it applies to all types of organizations, as you can see, whether or not incorporated in the United States, and whether, so it could be foreign corporations as well as U.S. companies. And it's labeled the allocation of income and deductions amongst taxpayers, as you can see here, but it's become known as the transfer pricing rules and regs, because it involves exactly that transfer of goods or services and how they are priced amongst, and the key here is also related companies. So let's see that part of this. That would be here, that it's two or more organizations owned or controlled directly. So that becomes the relationship issue, that they are related companies. And then it goes on to tell you that what the code section allows is it allows for the secretary, which in this case is the Secretary of the Treasury and really the Internal Revenue Service, may distribute a portion, blah, 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 the deductions and the income and credits, etc., amongst these companies if he determines that such distribution, etc., is done in order to for the evasion of taxes. So the Secretary of the IRS's redistribution of transfers and the pricing thereof would be to prevent evasion of taxes, or even, as you can see in the language, to clearly reflect the income of any such related organizations, etc. Okay, so that's the basics, which we covered last night, the pricing or the transfer pricing rules. However, let's clear the deck a little bit, get some room. However, the last sentence of this very small code section brings in something in addition, which is, in the case of any transfer of intangible property, the income with respect to such transfer or license shall be commensurate with the income attributable to the tangible. What does that mean? Well, that's a mouthful of words in a very short sentence with deep meaning. And what the tax courts over the years have interpreted this to mean is that commensurate means, when combined with the income attributable, to say that this is all leading up to one thing. What does the income stream look like as it happens? I'll explain. Usually, when we make the valuation of this transfer of, say, IT property, intellectual property, usually we would make that based on the present value of future cash flows. So what we would do is we would make a projection, forecast, and determine how much cash flow would be coming in the future because of this special intellectual property, this special know-how. This code section is saying that's not how you're going to value the transfer between related organizations of intellectual property, intangible property. You're going to value it based on what does it actually accomplish. This gives the IRS the ability to come in to do their audit years after a transaction and say, okay, now let's see what it really means. So what you're really going to wind up doing is you're going to constantly be adjusting, potentially constantly be adjusting the present value based on the actual cash flows. So it's as if the transaction is contingent on the future. It's a very unusual approach in the Internal Revenue Code. It doesn't happen too often that the IRS actually gets to use their 20/20 hindsight in making evaluations. They always seem to do it even when they're not supposed to, because it's easier to value something when you know what the future turns out to be. But here the code actually gives them that right to do it. So that, and it only is with intangible property. It's the only place where it occurs. So let's see what this means in terms of the real world. What is this all getting to? So in the real world, what happens is that a U.S. company, let's do that a little bit better here. In the real world, a U.S. company will in the real world, a U.S. company will do the following. It will take a corporation owned in the U.S., a U.S. corporation that has intellectual property inside of it, and it will transfer that IT property offshore to a foreign corporation, typically in a tax haven jurisdiction, for purposes of reducing future tax. And it will do this when this IT is relatively new and the future cash flows show it to have maybe little or no value. Because we can't predict the future cash flows, perhaps. It's where it's very hard to predict, so it may have little or no value. I'll put question mark, because we just don't know. Years later, of course, we're going to wind up seeing what the value was at this date, and let's call this date 1/1/15. So years later, by the year, just for example, like 2020, we would know what the cash flows are then, and we could do a new present value back to 1/1/15 and find out it's worth, like $1 gazillion, because it worked out to be I don't know if that's how you spell gazillion, but you get the idea. And so what the tax code does, we just saw, is it says do not value it based on the value at the time you make the transfer. Make the value based on what we know in the future. And the reason why that's important is the following. Under a very complicated set of rules within the Internal Revenue Code, under Section 367, and this is unlike what you may have learned in your business entity class, the transfer to foreign corporation of assets is not a tax-free event. It is subject to tax unless it meets the business purpose test, in that in foreign corporation, it will be active in that country. Well, as we saw from some of our class examples, most likely the transfer to this foreign corporation is not going to be inactive because it's in a tax haven and there's not much business to do there in that tax haven, and we're just trying to lower taxes. So what Code Section 367 was all about is capturing the transfer of an intangible to a tax haven where you valued it at a very low amount, paid little tax, and then it became very worthwhile in the future. So imagine this. Suppose on the start date, if the law didn't exist this way, here's how it would work out. We would say this had zero value, and we transfer it to FC, and we're done. And then by year 2020, this IT is capturing in mucho dollars in the foreign corporation, avoiding, deferring, maybe even escaping U.S. tax. It all stays there. The U.S. is over here, and it's helpless to get at the value of that intangible property as we now know it years later. This could be any year, by the way. This 2020 could be any year. I just picked that as an example. And now I realize it would have been a great example to say that this code section looks at this with 2020 hindsight. Yes, it does. And the way it would do it, it would now say that, you know what, the value of that transfer back in 1115, this now has to be taxed because this is in a tax haven. Again, an exception would exist if it's an actual operating entity in foreign country FC. And since it's in this case, it's in a tax haven, so we now go back and we say this value changes. It's a contingency value, and it constantly gets updated every year to its new value, and it brings back some of the tax dollars to the U.S. The U.S. is up here, let's say, and so it brings back some of the tax dollars under Section 367. Again, 367 is a very complicated set of rules, trying to avoid moving money from the U.S., moving assets from the U.S., moving intangible property from the U.S. to foreign corporations, and having the future tax or actual appreciation on the day you move those assets be escaping U.S. taxation because it could be a tax-free event. So if it goes to a tax haven, it's not a tax-free event. And how do you value intangible property? So this code section 482, the transfer pricing, gives us this 2020 hindsight. That's why I picked the year 2020. It's like a little joke. And please feel free to ask me questions on this in class when I see you, because it's an interesting part of our code section. This, by the way, before I forget, is what is known as, at least that last sentence that we looked at in section 482, that last sentence has become endearingly and lovingly known in the literature that is where tax accountants who play in the international tax arena, tax lawyers, it is known as the super royalty ruling or the super royalty rule, because of the fact that it's not just an intangible property that's transferred and it has a value the day they transfer. It's a constantly changing, it's a contingency, so it's sort of it's the ability of the Internal Revenue Code to capture what turn out to be super royalty intangible property yielding assets. Let me say that again. I think the reason for this expression, which is not a legal expression, this is just what we call it in the industry, this super royalty idea, is that it's not just a simple intangible property the day we transfer it but it's a constant looking at the future royalty or future royalty value of the intangible property when it's transferred off-seas to a foreign corporation, and specifically in an environment that is consistent and relates to what we learned the other day, you guessed it, subpart F, where it's in a tax haven, it's not actually having a business purpose there, it's just there for the lower tax rates. Okay, hope you enjoyed this. This is a fascinating topic, and I'll see you Thursday.